Alright, let's get right into it. This is huge news that could change everything for your money, for my money, and especially for the world of crypto. The date is September 18th, 2025, and something major just happened in the halls of power in Washington, D.C. After a nail-bitingly close vote in the Senate, Stephen Miran has officially been confirmed to the Federal Reserve Board of Governors. A new Fed governor? Why should I care? This sounds like the kind of news that puts you to sleep, but I'm telling you, you need to wake up for this one. This isn't just some boring bureaucratic shuffle. This is a potential earthquake for the financial system. Stephen Miran isn't your typical central banker. He's not some lifelong academic who has only ever seen the economy through spreadsheets and theoretical models. He comes from the world of macro hedge funds, specifically as a partner at Macroeconomic Advisors. He's spent his career making massive bets on the direction of the economy, interest rates, currencies. He's been in the trenches making real-world decisions with billions of dollars on the line. His confirmation signals a shift in the kind of thinking that will influence the Fed's every move, and that's where things start to get really, really interesting for all of us. Think about the Federal Reserve as the captain of the economic ship. For decades, that ship has been steered by a very particular type of captain, one who follows the old maps and traditional rules of sailing. Miran, on the other hand, is like a new captain navigating uncharted waters and isn't afraid to try unconventional maneuvers to avoid a storm. So, who exactly is this Stephen Miran, and why do his ideas have people so worked up? Let's dig in. One of his most talked about proposals is what some have called a third mandate for the Federal Reserve. Officially, the Fed has two jobs, a dual mandate: keep prices stable, control inflation, and achieve maximum employment. That's it. But Miran has argued in the past that the Fed needs to unofficially adopt a third mandate, ensuring the US government can afford its own debt. With national debt spiraling into the tens of trillions, the interest payments alone are becoming a massive burden on the federal budget. Miran's thinking is that the Fed must act to keep these borrowing costs low. Now here's the kicker, the part that should make every crypto investor's ears perk up. Years ago, before he was even on the radar for a Fed position, Miran was surprisingly open-minded about Bitcoin. In past writings and interviews, he acknowledged Bitcoin's potential as a form of digital gold and a possible hedge against irresponsible monetary policy. This is where the story gets really wild. Enter Arthur Hayes, the co-founder of BitMEX. He's one of the most outspoken and often prescient voices in crypto. Hayes has been connecting these dots for a while now. With Miran's confirmation, his thesis is moving from a far-fetched theory to a plausible scenario. Hayes has a bold, almost unbelievable prediction. If the Federal Reserve is forced to implement yield curve control, or YCC, Bitcoin's price won't just go up, it will go to $1 million per coin. Yes, you read that right, $1 million. It sounds insane, but let's break down his logic. Hayes sees Miran's appointment and his third mandate idea as the first domino to fall. The US government has an addiction to spending, and the national debt is the proof. At some point, the interest on that debt becomes so large that it suffocates everything else. The government has two choices: default on its debt, which is unthinkable, or find a way to make the debt cheaper. This is where the Fed, potentially guided by Miran's thinking, steps in. Hayes believes the Fed will be politically pressured into implementing yield curve control to artificially suppress interest rates on government bonds, effectively financing the government's spending spree. According to Hayes, this isn't a matter of if, but when. So let's really break down what yield curve control is, because it's a term you're going to be hearing a lot more. Imagine the government needs to borrow money, so it sells bonds. The interest rate on those bonds, known as the yield, is typically set by the market. If investors are worried about inflation or the government's ability to pay them back, they demand a higher interest rate. The yield curve is just a graph that shows the interest rates for bonds of different maturities: short-term, long-term. Normally, the Fed only controls the very short-term interest rate. With YCC, they try to control the whole curve. How do they do that? The Fed just announces a target yield for a specific bond, say, the 10-year Treasury note. They might declare, "We will not allow the yield on the 10-year bond to go above 2%. If the market tries to push the yield higher by selling bonds and driving the price down, the Fed steps in with its magic checkbook. It creates new money out of thin air and buys as many bonds as it takes to push the price back up and the yield back down to their 2% target. It's a direct promise to print unlimited money to enforce an artificial price on government debt. Even before this news about Miran, we were already seeing clear signs that big money is starting to get nervous and look for alternatives. The crypto market doesn't operate in a vacuum. It's a barometer for global liquidity. And right now, that barometer is pointing towards a storm. One of the most obvious indicators is the activity around Tether or USDT, the largest stablecoin. In just the last few weeks, we've seen billions of new USDT minted. This means real dollars are flowing into the crypto ecosystem, getting converted into digital dollars, waiting on the sidelines to be deployed into assets like Bitcoin, Ethereum. This is the dry powder for the next bull run. Another huge signal is the behavior of the so-called Bitcoin whales, large holders who can move the market. On-chain data shows that massive wallets have been accumulating Bitcoin at a relentless pace. Every time the price dips, these large players are stepping in and buying, absorbing the supply from weaker hands. This isn't retail FOMO, this is calculated, strategic buying. These are sophisticated investors and institutions who see the writing on the wall. They are front-running a potential policy shift from the Fed. They aren't waiting for the official announcement, they are positioning themselves now for the tidal wave of liquidity they see coming. All of these factors are creating a perfect storm. They are the tremors before the earthquake. So how is Bitcoin itself reacting to all this? In one word, explosively. In the days leading up to and immediately following Miran's confirmation, we've seen Bitcoin's price show incredible strength. We've broken through several key resistance levels, and the momentum feels different this time. It's not the frothy, retail-driven mania of past cycles. Instead, it feels more methodical, more powerful. But the price is only half of the equation. The other, more important half is supply, and right now, we are in the middle of an unprecedented Bitcoin supply shock. First, remember the halving that happened back in 2024. This event cut the new supply of Bitcoin created by miners in half. So at the exact moment demand is starting to pick up, the issuance of new coins has been drastically reduced. It's a simple case of economics 101. When demand increases while supply is constrained, prices have to go up. On top of the halving, we have the ongoing accumulation by long-term holders and institutional players. As we discussed, whales are buying, but just as importantly, they aren't selling. The amount of Bitcoin held on exchanges is at a multi-year low. This means coins are being moved off exchanges and into cold storage, which is a sign that buyers have a long-term conviction and have no intention of selling anytime soon. This creates what's known as an illiquid supply squeeze. The available float of Bitcoin that can actually be bought on the open market is shrinking by the day, making each new wave of demand have an outsized impact on the price. You can start to see how Arthur Hayes' seemingly crazy prediction of $1 million Bitcoin starts to look a lot more grounded in the principles of supply and demand. So, we come to the million-dollar question, literally. Is this prediction of a $1 million Bitcoin just a wild fantasy? Or is it a plausible outcome of the corner the Fed has backed itself into? This is not a certainty. There are significant risks and hurdles. The biggest question, will the Fed actually enact yield curve control? That would be a monumental step, an admission they've lost control. It requires a set of dominoes to fall in sequence: continued government overspending, rising debt costs, political will at the Fed to enact yield curve control, a global flight from fiat currencies into hard assets. Arthur Hayes is making a bold bet that all these will happen. With Stephen Miran on the Fed board, the first domino has tipped. Whether the rest will follow remains to be seen. For the first time, the path to $1 million Bitcoin is no longer just a dream. It's a visible, if treacherous, trail.